Yeah. We're here. I've got an excellent panel, largely coming from the investment side of things, and I'll let everybody go through their introductions, but really want to cover, we've been through a few cycles, starting to see after the calamity of 2022 that many of these patterns repeat themselves. So just wanted to take a moment and hopefully pass on some advice of past experiences that we've gone through that we see projects and builders sort of making the same mistakes that end up leading to getting taken out of these secular equations, right? We really want to see people succeed, launch markets. So with that being said, let me start by introducing myself. My name is Graham Friedman. I'm the head of venture at Republic. What we do at Republic is we work with a ton of builders. Obviously, I'm on the investment side, but we have an entire platform dedicated to go-to-market advisory, token development work around tokenized assets, around smart contracts, et cetera. One of the only launchpad platforms that can actually reach the US audience, as well as a variety of other assets. And that being said, I came into this space really early on in 2009 after Satoshi's whitepaper. And truth be told, we're seeing many of the same things as we go through this. So really want to use this time to tell some of those stories and impart some knowledge onto you fine people. Let me kick this off by introducing the rest of our panel. We have Ciara from CSquare Ventures, Austin from Coinfund, and my colleague on the builder side, Jeff, also joining us from Republic. The thing I would like to ask first, just to set the floor, would really be the origin story. Ciara, could you tell us what brought you into this space, and most importantly, when was that?
Okay. I'm Ciara, founder of CSquare Ventures. The reason I got into the space, back in 2017, I was doing liquidation still for Lehman Brothers. So that's how you see, the financial markets really need revolution. And I saw the Bitcoin white paper, and it's a trustless, efficient system to fix the problems that you would see for Lehman Brothers and Madoff, right? So that's what drove me into crypto. So I quit BCG and joined crypto in 2017. And I co-founded Exchange and then joined Huobi, managing the global markets, listings, investments, operations, and the institutional business. And faced regulatory pressure at the end of year of 2021, where China just shut down exchanges. So I left and went to Singapore and started CSquare Ventures with some of my ex-colleagues and some new friends. We raised $100 million from people like Google, Polygon, Tower, GSR, and just started deploying. And we just wish to help the founders and builders with our expertise with running tokens and just grow with them in Web3. Yeah.
And I imagine coming from the exchange side, you saw your fair share of successes as well as failures, correct? All right, excellent. We'll take some of those stories later. Austin, I'm going to pass the mic to you. If you could give us a little bit of your background as well as Coinfund, we'd love to know your story as well.
Yeah, absolutely. So Coinfund launched in 2015 as one of the first venture funds purely focused on crypto in those early days. And our approach has been similar throughout all of our history. It's investing early in strong founders from a thesis and fundamental driven perspective to push forward the adoption of crypto. And this is across a whole number of areas, including base layer infrastructure, middleware, DeFi applications, wallet level, really across the board. Personally, I got into crypto back in 2013, tangentially related to poker, I guess. My brother was invited to a poker game where the buy-in was with Bitcoin, ended up winning the game, and then afterwards calls me and is like, I don't know what to do with this, how to receive it, what it is, can you help me out? So we started digging in together. I was working in cross-border payments at an early stage startup at the time, and it was tangentially related to payments, so started diving deeper. And once I came across Ethereum in 2015, that's what really was the light bulb moment for me, is seeing this broad surface area for application building beyond just a new type of money. And since then, fell down the proverbial rabbit hole, built a borrow lend in 2018, 2019, worked at a crypto ETP issuer, and have been investing at Coinfund for the last 2.5 years.
Fantastic. Jeff, toss it over to you.
Cool. So very different entry stories, but similar, I guess. I won't do too many names because there might be crossover to the poker game. But I moved to Denver in 2010. I was working on a data startup actually in the sports space, and during that time, I was intro to co-founders of a product venture studio here in Denver. They brought me on to kind of help develop that offering. And I was lucky enough that one of those people in 2012 was also learning about Bitcoins and really wanted us to learn about Bitcoins. And we got curious as to how that could affect product development. And if you're a product developer, you're always looking for the most interesting user experience dilemma to solve. And on the horizon was the Ethereum mainnet launch and the birth of decentralized applications. And it's like, this is going to be the most interesting thing to work on. I'm going to have opportunities to work with founders building a very, very complicated user experience for the rest of my life. So we kind of flew the flag, said we're going to accept Bitcoin as payment. Let's see who comes knocking at the door ahead of this launch. And some very important people just by happenstance did, because no one was really a vendor to the space, focused on product development, focused on outsourcing, developing product experiences. The first product that we launched was Shapeshift.io. He's obviously a big proponent here in Denver. And then from that launch, we gained a lot of trust in the space. So we were hired by a lot of firms. We worked with DCG with the acquisition of CoinDesk and helped them launch the Consensus Conference here in the States. Worked on Exodus Wallet, lots of Bitcoin.com products, and the rest is history. We built that firm to about 45, 50 people. Worked on some 80 crypto startups, it's been kind of a wild ride, and I really just kind of got lucky with my co-founder bringing me into the space and aligning with the things that I wanted to work on, which was kind of democratizing the world a little bit more. And as Graham mentioned, now I'm head of tokenization at Republic, kind of helping to do that for our Portco and our clients.
Excellent. So let's get into some of the problem areas that I believe are some of the most consistent across generally the bear markets, but truth be told, I would say a lot of the poor habits actually start in a bull. It's very easy to develop some of these themes that will take you down when the money is very easy and it seems like there will always be an upside tomorrow, and then suddenly everything disappears from under you. It's something that everybody's probably very familiar with right now, and it's great to see all your faces here in the middle of a bear market, so fuck yeah. First and foremost, I think one of the biggest things is treasury management. And I'm not sure that this is something that people get a very good grip on as you start your trip into launching a company. Obviously, crypto is a very unique space. There is a lot to learn simultaneously from regulation, from operations, from the fact that maybe taking in money can go from being very easy to very difficult, or vice versa. But I think the big fish in the room started in 2017, right? The ICO era made it so amazing to crowdfund your technology out to anybody, right? They could sign on, they could toss an ETH, they could get a token back, run that strategy over and over again. This was the state of blockchain in 2017, right? Really, we've come a long way. One of the things that I think I would love some of your opinions on was what followed 2017 was tons of projects holding their treasury in a volatile asset, right? Everybody had raised capital in ETH. ETH had gone from, $1,200 down to $100, something to that effect. And suddenly all these awesome founders with great ideas were completely wiped out. Subsequently, we've moved on. You will see most people raise capital these days in stable assets. But nonetheless, treasury management continues to be something that is quite difficult. Would love to know if anybody has a tale specifically around treasury management that you've seen with some of your portfolio companies, maybe what's been done to alleviate their issues, or even show that the mistake actually ended the company.
Yeah, so I remember back in 2017, like the beginning of the ICO age, people raised in Ethereum, right? And they raised, I remember, one example, Lino. They were later acquired by Tron, right? Tron Group, D-Live was acquired, and then the founders split up, and they now started really successful projects. We backed both CyberConnect and Project Galaxy. But I think one thing we've learned with them is that back when they were raising for Lino, they raised Ethereum, and Ethereum price was at $800. And bear market hit really, really quickly, and without even notice, the price was like 200, and then fell down 100. So it was really, really hard for the team to maintain a, very good backgrounds of engineers in the Bay Area and with the office rent and everything. So I think that's a hard lesson that we learned for treasury management. So now I think we don't really see projects raise Ethereum or other tokens anymore, but we do see some swaps. So different projects invest in each other or ecosystem, and they got their native token as either as a grant or as a investment form. So we would really suggest our portfolio companies to convert them into stablecoin. And that's one thing, right? Like what currencies you hold, and also how do you store them. Like last year when we started CSquare Ventures, we saw some really good companies, but led by FTX or some other exchanges, and were required to put all the capital they raised into their exchange account. So no matter how much we love the team, we had to pass. And that's just a big red flag, and is a very high risk. And it turned out, some of the products suffered a lot from this. So I think when you look at storage of your assets, you need to think of whether is there like a real custodian. You look at how much the interest is offered for the money you put in. Either it's for exchanges or asset management or any other centralized asset platform. If it's only offering 20% of insurance, which is already considered very high in our industry, you have to think it as, okay, we are giving away 80% of the assets the second you put it into that platform. So we would never suggest projects do it. And for us, US dollar we raise is in the bank, and we don't even use a crypto bank, we use a traditional bank. Or if it's stablecoin, we hold USDC, and it's managed in a wallet. We don't really put it in any other places. I understand in bear market it can be really stressful when you have a short runway. So some of the projects think that if we put it in, say, exchanges and get a 5% interest, and that's a good amount of money, yield every month. But you're not here to make percentage every year, right? Like that's not your goal. You're here to have a very healthy runway to build whatever you want to build, and then made it in the bull market.
I completely agree, and I think a lot of the core tenets here are basically setting up your treasury to mitigate any black swan events, right? Which can come in the form of many things. We're seeing one of the very basic banks go down right now. Usually my advice would be just put it in a boring bank. But while we're talking about 2017, doesn't apply as much to people raising through equities, through SAFs, but this is still very relevant for NFT projects. They are taking in the speculative asset, and this year, I mention this and harp on it because I have a very amazing project. They've got a music deal. Everything looked like, to the moon, and really, based their entire treasury in one of the L1 assets. This L1 happened to, take a bit of a dent in the downward spiral, and I literally watched a project only a couple months ago go from being on the top of the world to thinking, how do we fund ourselves, for the next couple months? And that comes back into your fundraising rounds, right? And I want to talk to you, Austin, about this. When people raise, they seem to do it with this expected timeline in mind. And I keep hearing founders, say, we've raised X amount of capital, it'll get us through to the next raise. But we're in a bear market right now. So I'd be very curious to take it, from your POV, maybe from Coinfund's. But is there a next raise? How should you think about that?
Yeah, so I think there's a couple of things there. One, it's very important for projects to be careful about raising too little money because, when you've attracted investor attention and people are very excited about what you're building and the market's stronger for fundraising, you have the ability to raise more money. And a lot of teams try and manage dilution by raising very small amounts. and then saying like, well, I'll have runway for the next 8 months until I get to testnet, and then I'll raise again, and then I'll get to mainnet, and then I'll raise again, and everything really has to line up quite perfectly, and you don't have the opportunity to make mistakes. You don't have the opportunity to pivot and to iterate. So I think it's really important to give yourself some breathing room and have longer runway, because you don't know necessarily where the project will take you and what the fundraising environment will look like at that time. So I think that's one thing, but also you shouldn't necessarily, if you're raising at the seed stage and you're imagining like, well, what do I need to achieve to raise my A, that actually changes a lot by market regime, where in stronger markets, it's been a certain amount of months and you've hired a certain amount of people and the product is, more advanced by this amount. Whereas in tougher markets, and, I'd say now kind of fits the bill, there's really an expectation of meaningful traction to raise the Series A. So it's a much higher bar to raise. So you never want to put yourself in a position where you're running out of capital and then you need to make those really tough decisions about like, can you keep everyone on the team on board, or do you have to make cuts, or do we have to eliminate a product line that has a lot of potential but is not quite there? And those are that's the sort of breathing room you want to afford yourself.
Yeah, just a follow-up question for that. Just as we're in a bear market, and I know Coinfund's still deploying, are you even seeing any of those growth stage, so Series A, B, or is it all seed? I mean,
we're continuing to see not quite as much Series B, but a lot of Series A. But I think there's a mutual understanding of what's required to get funded at the A level right now, and it's seed requires a very strong team, a vision, strong product roadmap, but not necessarily traction. And Series A very much requires the traction, whereas in the past, it almost was a seed extension of sorts in terms of what was required. So we're continuing to invest in a number of Series A deals and are very excited about that stage. It's just the requirements are a little bit different because the risk appetite is lower across the board.
Yeah, and I would say for anyone exploring this, it is good to talk to those investors prior to needing the money like direly, to understand what that landscape is and how you can get.
Yeah, and also one other thing to add, I think sometimes founders are not sure if they should reach out to investors if they're not raising at that point, or if the product or the business isn't exactly at the most, let's say, like presentable stage where everything is perfect. But in a startup, nothing is ever perfect and nothing is ever in that presentable form. And you'd be surprised how much investors are just happy to chat and happy to be helpful and make introductions and just learn about what you're doing. And then when it comes to the time to raise, they already have a lot of familiarity with you as a founder, with what you're building and what your path has been from there to here, and it makes raising a lot easier.
Yeah.
Take it away.
Yeah, I'll just add, because we are often working from the builders camp. Like, we're in the builders corner, we're working with them, we're helping them to develop their product, which equates to a value proposition, which equates to a TAM, and so we're working with them a lot on how they're trying to do private fundraising. So to your point, like your investors always want to hear from you because they want to be strategic for you. So never stop talking to them, especially after you've closed a round, at what you see as far as a pivot that could be happening to your product. One thing I do see with when you can time the market to raise money and you can raise a lot of money, you do want to find a sweet spot. I don't think you want to raise money you can't develop an accurate use of proceeds for, because otherwise you are building a team against benefits and features you have to develop because you've kind of expanded what you're going to be building to raise more money. And then you could find yourself in a situation when you're not really focused on building one thing that's really, really valuable that's going to afford you the ability to keep on going without investment if you needed to. So that's just one thing that we've seen is like, we've seen TAM get really, really big because it's based on your ability to raise more money, but you need to have an argument for it, and it's really far away from your main value prop. So that could be tricky.
Yeah, and I'm going to use that to really segue into one of the other major issues that I see over and over again, which is your staffing. I think you want a really clear vision of what staff is necessary, how you handle those positions, and how you will use that capital to pay for them throughout the range of the next round. Honest to God, like one of the most common things we see, and this is probably a bull market issue, to be quite frank, is that founders get a ton of money, right? Suddenly, you're on top of the world, you're feeling great, you're well padded, and people begin to hire like mad. I see this over and over again, and I really want to toss it to you, Jeff, because I know this was, to me, Shapeshift was emblematic of this in 2017, and it's a recurring issue that we see to this day. So I would just love to get some of your take on that.
So this is one you probably are not going to think about. So you're going to build a product. I've been on the venture studio side for a long time, and it's like if you're building a product and you've hired us to build something integral to your product for you, look at my team. Pair program and build your product according to my team. I'm telling you what your staff needs to look like for your, like, call it your Genesis team, like what your team needs to look like as soon as you leave our camp. Then you hit success building with that small team, and then you ramp up, and you need to throw, what projects tend to do is they tend to throw people at the problem, which is not what you should be doing.
Preach.
Yeah, you should not be throwing people at the problem, because it's honestly just going to expand all of your problems. And where you are going to be needing to staff up on the back end of that is support. So you could either spend a ton of time building the right product, or you can spend a ton of money hiring a lot of support to answer all the questions because your product was not built right the first time. So it has this kind of like whiplash effect of, we've built this really great product and it's doing something, however, users can't use it in the way that they need to because we rushed it to market. Now you have this big support staff bill that's coming on, and it has this kind of like vicious, again, like whiplash type of cycle.
Absolutely. And Austin, I'd be curious, just like in a broad percentage sense, how many of your portfolio companies had to do a significant downsize?
I think we were very fortunate that it was actually quite a small percentage, so directionally less than 10%, which I don't know necessarily reflects the broader market. And I think a lot of teams, though, have been able to manage that pretty well throughout this cycle, learning from prior cycles. But as a founder, it's the toughest thing that you'll ever have to do is fire people, and you don't want to put yourself in that situation. And also, one thing that people think about it in bull market cycles that puts you in a very bad place is they often conflate hiring with advancing the project and building. And I'll hear sometimes founders go to investors, it's like, oh, we were 10 people and now we're 30 people. And that doesn't mean that you've built anything, it means you just have more people. So I think that distinction is really important.
Ciara, similar question to you. Just how have you seen the projects handling staffing, de-staffing, et cetera?
When we think of overstaffing, so easy breakdowns two kinds of stuff, right? Like either it's focusing on the product engineering side, or is the business and marketing side of the people, right? So if you see projects hire too fast and expand their product engineering team, and then had to lay off a lot of them, a lot of the times we see it, well, back at the exchanges time, of course, it's because they get distracted. They're like building the shiny things, building something that was not originally on the roadmap. So that happened actually a lot to exchanges because, as the centralized exchanges, that's where the liquidity is aggregated. That's where the information is aggregated. And I guess, they feel obligated to do innovation stuff and to lead the market, right? But sometimes they get distracted so much. I remember we had a innovation labs at Huobi, and it was like 200 people or something. And when you see bear market hits, and when you see companies lay off people, it's usually the exchanges. And the people that they lay off are usually who's working on those new type of experiments. So for portfolio company, who is not like a, money printing machine, you don't necessarily have a cash flow yet. So just focus on building what you originally had in mind. When your seed investor back to you that was your vision, just stay on track and build that. And I think that avoid a lot of the overstaffing on the product engineering side. And then for marketing and business, I think when bull market hits, people are always competing for the first mover advantage, right? They wanted to take things out, go to market, and get as much attraction as they can. I think that's all right. But instead of hire 100 people team, you can use like really good marketing agency and local communities, work with affiliates, work with community leads, and work with those agencies who has tons of experience with helping products go to market in their region. In the past few years, that's like so much better than you just hire like a huge marketing and BD team and then have to fire them when bear market hits. Yeah.
Totally. And during this sort of downsizing period, I'll be honest, the one thing that was consistent across every single one of my portfolios that had to let people go was the CEO said, you know what, we are more efficient and effective as a smaller team than with all of those extra people surrounding them. So
Yeah, well, one caveat I just want to add, because we've talked about some of the downsides of growing too fast and how you should manage teams, but hiring is very helpful when you're growing quickly, and like you want to build the team to be able to support what you're building. But one of the important things to do when you are growing your team is, especially if you're a first-time founder that's never managed a team of 15 or 30 or 50, lean on your investors that have helped teams, help founders scale up teams and have best practices around how do you run like a performance cycle, how do you manage compensation of your team, how do you structure subdivisions in organization, how do you think about finding the right mentor. One of the things that can be really helpful is finding a mentor that's a couple stages ahead of you, that's within that portfolio, or you within the industry. So say you just raised your seed round, find someone that's within maybe the portfolio of your lead investor, or someone that you've met that's raised an A, raised a B already, is running a 100-person organization and is further along, and they can really help you get to that level.
I agree. I think talking to people who have been through, let's just call it the ICO process, but the go-to-market, also useful. Guys, there's like hidden legal fees everywhere. The legal landscape is constantly changing, right? Business relationship, market makers, exchange listings. There's so much knowledge to be gained from somebody who's done it once. It's like, my wife always says she could throw a wedding so easily now that she's done it. Same kind of vibes. But anyway, guys, looks like we're just about out of time, so I'm going to end it here. If there's any questions that people have in specifics, we'll be around, happy to chat. But I certainly hope that this was helpful and useful advice to all of you. Thank you.